Hello and welcome to the second video in Business 150 Chapter 8 where we're dealing with personal finances. We're now going to start talking about financial planning. We've learned some things relative to how to manage some of the money that we have. Now let's talk a little bit about the true term of financial planning, where we manage our personal finances to meet goals that we set for ourselves or our family. So the questions for financial planning, is how much is the annual income? How much debt and payments do we have? And those are things that we are required to pay, such as rent or home mortgage or car payment or student loan payments and so on. What are the value of all of our assets? How much money do we expect to take in and spend each month? How are we going to accumulate wealth for future activity? And then to even begin to start talking about and thinking about money for retirement. So here is a financial planning life cycle, and it has a lot of information that I would just like to have you take a look at for just a short moment here. Up on top here, we have different stages. And so while we are working in our career and retirement is a ways off, what we're looking at in this stage here from, say, 20 to 50, 55 is building wealth. And then in stage 2, as we get a little bit closer to being retired, then it becomes not as important to build wealth, but to preserve the wealth that we have accumulated. And then lastly, step 3 deals with living on the money that we have saved. Again, young adult, family, and retirement, you can see here. And what we have here is the trajectory of the monies that we are accumulating. So again, from the beginning of our life through our careers, up to age 50, 55, we are accumulating the greatest majority of the wealth that we're going to have. And then over the next few years, again, we need to sustain or preserve that, and then eventually go down as we spend it in our retirement. And so again, you can see debt from when we're young to this time frame. That's when you normally will have some kind of debt. You have needs for insurance and investments and estate planning are all at different times of your life. So it just gives you a feel for some of the different aspects of planning. So just wanted to share with you, you know that college is expensive and sometimes wonder if it's worth it. These are some statistics that are very important to look at. The average income of somebody that stops going to school at a high school level makes about $28,000 a year. A 2-year degree with some colleges roughly $30,000 a year, and somebody with a bachelor's degree is $45,500. And again, those are averages, but you can see that although the education has a cost associated with it, there is a return on that investment based on future earnings. So a compounding interest is interest that is earned on your savings account and that is added to your savings account. And then when we add interest, we're getting interest on the interest. So here's a short little example that I put together. If you have $20,000 in a savings account and it pays 10% interest, you get $2,000 worth of interest. And so at the end of year 1, you have $22,000. The next year, you get the same $2,000, the next same $2,000, $2,000, $2,000, and at the end of 5 years, you have $30,000. That's what we call simple interest. But if we have compound interest, which means interest is paid on the interest, we go from 20 to 22. Then the 22 gets interest, which takes us to 24,200, 24,200 to 26,000, etc. And you can see at the end of the 5 years, we are 8 to 9, almost 10% greater, because why? We're earning interest on our interest. And that's why saving small amounts of money for retirement or for the future when you're young has such a tremendous impact on how fast it grows. This sheet here, I actually don't recall what the interest rates were, but it basically said that if you start saving at age 25 and you save, let's say, $6,000 a month per year when you start at 25, by the time you get to age 67, you will have $1 million. So again, at 25, saving $500 a month toward your retirement can generate $1 million by the time you're 67. If you wait till you get to be 35, then it's going to, if you save that same amount, you'll have to, right here, work till or save till 72. And if you wait 10 more years, you have 10 more years before you become a millionaire. Or if you want to look at it, how much you then have to save to get $1 million. If you start when you're 45 and you want that roughly $1 million when you get retired, now you have to save $20,000 a year. And so again, this idea of compound interest, if you start even a little bit when you're young, it will grow over that 20, 30, 40 years pretty substantially. So another key term that is important when you talk about finances and personal finances, what we call the time value of money. That is where the dollar received in the present is worth more than a dollar received in the future. If I give you $10 today, or I give you $10 in a year from now, that $10 today is technically worth more. Why? Because you can invest it today and earn money, or if you use it to buy something with the rate of inflation, the $10 will buy more today than it will in the future. And that's why a dollar received today is worth more than a dollar received in the future. So the steps in financial planning, first and foremost, is to evaluate your current financial status, set your goals, and then use a budget. If you've looked at the activity for this chapter, we are going to help you create a basic budget for when you graduate as a way to help you begin this financial planning process. There are two financial statements, a personal net worth, and if you think of it from the chapters we just discussed, it's similar to a corporation's balance sheet, and then a cash flow statement, which shows the money coming in, the money going out, which again, think back a chapter or two, dealt with the same as an income statement for a business. Here's an example of a personal net worth statement where we add up all of the things that are of value, the assets we have, and then the liabilities, what we owe. And in this case, if you add up all these assets, the person has $12,700. They have roughly $10,700 worth of liability, so their total net worth is $2,000. Understanding what your total net worth and having goals on how to increase that are really important. If we look at a cash flow statement, this is obviously a little more detailed, so the amount of money coming in is $25,700. The amount of money going out is $25,300. That's on an annual basis. And so we're taking in approximately $400 more than what we're paying out. Now again, the two things to keep in mind is to monitor to make sure that this is the correct number, that things, that we're always making that amount of money, or at least knowing how much money we bring in, and then controlling our expenses so that we don't spend more than what we've got budgeted, because that will impact this inflow and outflow amount. So financial goals should always be looked at in three terms: the short term, the immediate term, and the long term. So short-term goals are for the next year or two. Okay, what are my goals? It might be to get through school, or if you're on the end of the school in the next couple years, is to get a job and get established and so on. Intermediate terms might be something more like paying off my student loans or purchasing my first home or something along those lines. And then long term is more again on building wealth and planning for retirement. goals should always be looked at as these four adjectives. They should be realistic. Saying that I'm going to make $500,000 my first year out of college is probably unrealistic for most people. Saying that I'm going to save 92% of all the money that I make is probably unrealistic for many people. They should be measurable, meaning you can actually measure if you are doing what you're doing. Saying I'd like to save more money is a realistic goal, but it's not real measurable. What does it mean to save more money? Is that just a penny more, or is that X% of my income? A time frame. I want to do it in a certain period of time. I want to have my student loans paid off, by the time I reach 30. And then lastly, what type of action do I have to take in order to meet those goals? So develop a budget, wages, loans, credit cards, pay those off first if you have them, and then always keep track of actual versus budget, because some months you may need spend a little more on your transportation because you need some maintenance on your car, or potentially have some problems with your car. And so understanding what the variance is between your actual and your budget is extremely important. Here's a chart of U.S. savings rate, and you can see that from 1960 to 2016, in general, the United States has saved less and less and less money. And again, if you look over here, this is 2.5%, so this would be somewhere in the 3 to 3.5% of all the money that we make in the United States, and we are a very wealthy country. We spend 96, 97% of all the money we make. And you can see that doesn't leave a lot of room in case something happens. So it's important to understand the importance of saving and how much we're saving. Before we end this video, I'd just like to bring up the retirement savings accounts, because as you leave the college and go to work in company, many of them will offer you retirement savings accounts. There are two types. There is a traditional or a conventional savings account, retirement savings account, and then a Roth. A Roth, the way it is established today, means that you pay tax on that money, but then when it grows, it will grow interest-free. So if you take money off of your paycheck and put it into a retirement account, in the Roth scenario, you're paying tax on the money you make today. But as that money grows over that 10, 20, 30, 40 years, as we looked at earlier, when it 20, 30, 40 years from now, and you take that money out of your account, you don't have to pay any taxes on it. The conventional retirement account, you are able to save money pre-tax. So if you make $30,000 and you save $3,000 for retirement, you can take that off of your income before you pay tax. So you, in essence, would only pay tax on $27,000 of your annual income. However, in the future, when you take that money out of your savings account, your retirement savings account, you will have to pay interest. So I can't give you advice what works best for you. I just want you to be aware of that so you can plan accordingly. This wraps up the lecture for Chapter 8, Personal Finances. If you have any questions, please get a hold of me, and look forward to working with you on this topic if you have any. Thanks, and have a great day.